Good morning, I'm George Bennett, CEO of Rainbow Rare Earths. We are a rare earth company that's extracting rare earths from waste phosphogypsum, which is proven to be very, very low cost and very, very economically effective compared to a typical rare earth project, which has hard rock mining involved in it.
George, lovely to meet you. We've not met or spoken before, so thanks for coming on the platform. Can you tell me a little bit about yourself? What's your background relative to what you're trying to do with this project?
I would think my background is pretty well suited to what we are doing as a team at Rainbow. First of all, I spent 16 years as a stockbroker investment banker. I was a partner in a very successful business in South Africa that we sold to HSBC. And then I became CEO of Shanta Gold, which is a mining exploration business in Tanzania, which I took from 300,000 ounces to 1 million ounces and listed that on London. And it's got 2 operating gold mines. Then I started a mining engineering business, which was bankrupt in South Africa. I refinanced that and listed MDM Engineering in London. We built 22 process plants and mines around the world under my time and did many feasibility studies, including 2 rare earth feasibility studies. And we built 2 uranium plants, which is quite significant because it's some of uranium is part of the rare earth sort of space. And now I'm actually doing the opposite. I'm now actually building a mining company, and I'm using engineers, but luckily I know a lot about the engineering side of that as well.
Right, okay. Seems like you've been around the block a bit. Look, I appreciate that, George. Look, I guess the thing which I always say to investors is you kind of got to understand the man and the plan. So you've got a couple of projects globally, but what's the game plan for the company? What are you trying to be? What are you trying to do?
Yeah, we are trying to create this independent Western supply chain outside of China, and also we need to do this to be at a very low cost, to be cost effective, to compete with Chinese pricing. So because we've got no mining costs, we are extracting the rare earths out of phosphogypsum, which is a waste residue, as a result of phosphoric acid production. When you make phosphoric acid, you use phosphate rock slurry. You've got rare earths in the phosphate rock. They're not economic to mine on their own. You produce a phosphate concentrated slurry, which you feed into a phosphoric acid plant. When you add that slurry into a phosphoric acid plant, you add sulfuric acid and heat, and this creates a gypsum waste residue. The rare earths were upgraded in the phosphate concentrate slurry, and those rare earths now deported with the waste residue onto the gypsum stacks we have in South Africa, and we've got the same opportunity in Brazil that we're busy doing as well at the moment. We've started our initial feasibility study on the Brazilian project, but we're very advanced on the projects in South Africa called Pelaboa.
So tell me, okay, you're kind of focusing in on low cost, high margin. I guess that's one shade, but what else is it going to take to succeed ex-China? Because that's where you have a lot of companies come on and talk about ex-China, and trying to work out how they take advantage of that kind of adversarial position that we find ourselves in this space. So apart from cost management, what else is it going to take to win in this space?
Capital intensity is a big thing as well, because we are a very low capital intensity project by comparison, because we don't have all those other costs, as I've mentioned, of mining and drilling and blasting and crushing and milling and so forth. So we circa $300 million of capex from start to finish. We are producing separated rare earth oxides, which is similar to Lynas in Australia, and we're producing what's known as an SEG+, which is samarium, europium, and gadolinium with dysprosium and terbium, 2 of the key rare earths used in permanent magnets, and we're going to be separating neodymium and praseodymium, 2 of the other key ingredients for permanent magnets. So we're going to separate neodymium, praseodymium, and the SEG Plus group, which, as I mentioned, is exactly what Lynas have done their whole production career. But we're not going any further downstream than that. We will then sell that to what's known as the midstream, which turn it into metal and alloy, and then they in turn feed permanent magnet factories. And this Western supply chain needs reliable supply to come on stream that will not be affected by the vagaries of Chinese pricing, and Rainbow is one of those companies that can claim that.
Right, and obviously with the projects, Uberaba and Phalaborwa, you own those 100% at the moment, is that right?
Big pardon?
You own both projects 100% at the
No,
moment?
we own the project in Paderborn. We've got 85% with a 15% an option to acquire the balance, which we'll exercise next year. And in Paderborn, not Paderborn, in Uberaba in Brazil, we've done a joint venture deal with Mosaic, a global fertilizer business. They have sort of a $15 billion business. And we've done a JV with them to 50-50 extract the rare earths out of their phosphogypsum waste residue. Once again, they're producing phosphoric acid for their fertilizer business using the same process that we had in South Africa. And that's why I saw the opportunity, and I did a deal with them 18 months ago.
So what are you? Is this a technology company, or are you an operator business? How do you position yourself?
Well, we're not really a mining company. We are a technology company applying our IP to effectively a chemical processing plant. Both sites are brownfield sites. They're chemical processing sites that were originally permitted from South Africa for phosphoric acid. And the site in Brazil is a live stack. In other words, they're still producing phosphoric acid, and they're producing phosphogypsum every single day there. So it's a very, very long life project in Brazil, and whereas in South Africa we have a finite life of 16 years.
Okay, and so when you talk about sort of capital intensity of these projects being important to you, when you're going out for the kind of debt portion of this, I mean, how do those debt providers feel about perfecting security? What are they perfecting security against when they do this? Is it future revenues only, or is it your portion of any kind of physical asset that they're looking to?
In the case of Paderborn, which we will be going to debt financing later this year and for next year, it'll be we will own the stacks 100%, 35 million tons with high value rare earths in it. And our future earnings, we've got an EBITDA margin of over 75% in our project, and IRR of between 45 and 50%. You don't get that in mining projects. So as I say, we're not really a mining project. We're a chemical processing project. One will effectively call us.
Right, but if I look my banking days, I'm sort of looking at the kind of say rare earth pricing. I guess it can be opaque, and it definitely can be erratic. So again, where do they kind of get comfort from? Is it just purely on the margin there that you're talking about, or are you able to kind of show kind of route to market and forward sales, etc.?
No, definitely we will be engaged with offtake agreements. Fortunately, a few weeks ago, MP Materials in the US with the Department of Defense signed a significant deal, which was to set a floor price for neodymium praseodymium, which is 75% of our revenue in our rare earth basket, at $110 a kg for neodymium and praseodymium. And this seems to have set a benchmark for the industry. We saw Apple then come and do a deal with MP Materials, which has raised the profile of the whole sector. And we've also seen the Australian government talk about floor price for critical minerals. And now we have the broader G7 talking about potential stockpiling and floor pricing for these rare earth materials. So I think, as I said, that means that in our offtake contract negotiations, we have a benchmark to work with, and we will be looking to have some kind of floor price for offtake, and that will give the debt financiers comfort.
Right, and do they have comfort over the kind of future demand in the space as well? I mean, does any danger of this place the market getting flooded?
Unfortunately, there's a danger of a massive deficit in the market, because the heavy rare earths, dysprosium and terbium, are very, very much sought after, and we've got those in both our projects. And the problem is that most of it's controlled by China, as we know. So when you're trying to build a robotics business in the US and in Europe, and your EVs and your plug-in hybrids, and even your ICE commercial vehicle takes permanent magnets. So an ICE commercial vehicle takes about 1 kilogram of permanent magnets. That's your internal combustion engine. And your EVs are between 3 and 5 kgs per vehicle. So these permanent magnets affect the whole supply chain, not just your plug-in hybrids and your EVs. And to have that diverse supply chain ex-China, I'll be calling for a floor price publicly for over a year in this space, and I was very pleased to see I was vindicated when the MP deal was done.
Right. Yeah. I think that they did a lot of favours for a lot of groups at the moment. But I guess the important bit is that setting of a floor price, so we know where we are. In terms of moving the projects forward, there are sort of different stages and phases at the moment. Can you sort of talk through, where they are, what you're going to need to do and deliver over the next sort of 12 to 18 months to kind of get this financing in place? How does pilot scale validation work?
So we've been making significant announcements over the last couple of months of the optimization of our capital, as well as our flow sheet in terms of impurity rejection and producing a very, very high grade mixed rare earth product, or MREC, mixed rare earth carbonate. Rainbow could stop there because lots of projects stop at a mixed rare earth carbonate, but and so we are 100% de-risked at that stage, and we produce one of the highest grade mixed rare earth carbonates available in the world at the moment. So we're expecting a very good payability on that, but we are not stopping there. As I said, we're going one step further. We are going further downstream to separate neodymium and praseodymium and produce the ECG plus group. So that final step, we busy costing and designing, and will be within the next 2 months. That will be announced as the final step in Rainbow. But as I said, we know the route to market in terms of where we're going with separated NdPr and ECG plus group, and also we are busy with offtake discussions at the moment.
Okay, and I guess just to remember, you also mentioned the US government in MP Materials and Apple, but you two are in conversations with the DFC, US DFC, Department of Financing initiatives. What stage is that at? How realistic is that?
So no, that's very real. So you're quite right. We've already got a high visibility within the US government, because we have got a $50 million commitment from the DFC, that's the Development Finance Corporation out of Washington, which is a US government agency, and that's $50 million of equity into the Palabora project, and that money flows at FID, and it's based on the NPV of the project and forward rare earth pricing. So we know the formula, and that means that the US government will end up being a shareholder in the project in Palabora itself. We expect to have 2/3 of debt in our project, and when we talk here circa $200 million of capex, 2/3 debt, that's $200 million will be taken for by the debt providers, and that means we only need $100 million of equity, and already $50 million of that equity has been committed to by the US government via TechMet, the Critical Minerals Fund. TechMet have 12% of Rainbow Topco, but the DFC coming through TechMet will get project equity at Project Co.
Okay, interesting. Okay, well that's good news. You talked earlier on about being an IP company, more of an IP company, which I guess is useful because it gets a different multiple in terms of valuation, or should do. In terms of right now, this is about delivery on both projects, but you've also, therefore, I assume with the IP, got the chance to license this out to other groups. Is that something you're looking to do? Would you replicate the current model, or would you change things up?
No, we would look to rather replicate the current model rather than just get a licensing fee. So as I said, we've got a lot of IP we've developed to extract the rare earths out of the phosphogypsum. When I saw how good the Palabora project was going to be, I started looking around, and I found the Uberaba project in Brazil. And since then, we've been approached by Canadian Junior to see if we would, if they could partner with Rainbow in a similar deal. So we'll see where those negotiations go. We've also been approached by a group in Europe looking to do a similar thing with phosphogypsum waste residue. And we have an approach with Saudi Arabia and Morocco, where they've got very, very big phosphogypsum stockpiles. They are they are a sedimentary source of phosphogypsum. So that will take a lot more R&D to be able to develop a way of extracting the rare earths out of there. But at least we are in negotiations with these two potential long-term sources of rare earths out of those phosphogypsum assets in Saudi Arabia and Morocco. So Rainbow has attracted a lot of attention by developing this IP and successfully running a pilot plant, successfully producing high-quality MREC, and successfully going downstream. This, as I say, created huge visibility for us, and that's why we've attracted this interest.
Okay, so just help me understand again, I know you've touched upon it in this conversation so far, which is obviously this ex-China component, and I'm trying to understand, is this something which is sustained? As in, we would expect the Chinese export restrictions to, certainly with DYTB, to stay in place, or as is the history of rare earths, the spaces can be quite erratic. How do you kind of future-proof or forecast pricing margin in a market like this in terms of your offtakes, in terms of your partners, and what you can hope to sort of see?
Well, I think what we are seeing, and it will continue, is a bifurcation of the pricing from the Asian Metal Index, which is effectively Chinese pricing, to a Western pricing. We already seen dysprosium and terbium trading in Europe for the last 4 or 5 months at 2 to 3 times higher the price than the Chinese pricing. And since the MP deal was announced, we saw the price of neodymium and praseodymium start moving from circa $60 a kilogram up to about $84 a kilogram right now. So this has already had a massive improvement in the price of neodymium and praseodymium. And I think that's just testament to the fact that the Chinese pricing is not the correct pricing, and the market needs to normalize. And even if it does, we'll see guys rather focusing on supply, strategic supply, and pricing at where they can secure their material from. I mean, if you look at Linus over there last, I think 2 quarters, the price they achieved for neodymium and praseodymium was circa $82 a kilogram. In Japan, that's because the Japanese are not interested in what the Chinese pricing is. They'll pay a price to secure supply. And over that whole period, neodymium and praseodymium was trading at $60 Chinese pricing. So I think that's testament to the fact that we will have a splitting of pricing. And, the whole world will still need Chinese supply to a certain extent, but it's no good when you have 95% of your supply of permanent magnets coming from one source, especially when they are so critical in military applications as well. And you've seen an increase in drone warfare, but, drones being used in warfare. This is going to be a big theme going forward. You see the EU is now going to spend 5% of their GDP on defense. That's going to mean a lot more money going into defense, and drones are a big growth area for permanent magnets, not only in drone deliveries like Amazon, but as I said, in warfare. We also see robotics. The theme of robotics is now very, very much entrenched. Between now and 2040, the forecasts are very, very conservatively 1 billion humanoid robots on the planet. By 2040, they all require permanent magnets. This is going to outstrip demand for EVs, in fact. So the macro for permanent magnets is even stronger than I believe people are anticipating. And as I mentioned, coming back to defense, your permanent magnets are used in your high precision ordnance and your missile guidance systems and your tanks and your California class submarines. Your F-35 fighter jets got almost half a ton per jet of rare earths in it. So, with the geopolitics the way they are, this is putting even more sort of focus on the area and the importance of securing independent supply chain for the Western sort of users of these critical minerals.
Terrifying. Mine to magnet to defense. Hopefully wind, EV and robotics feature heavily in there too. How does I hate to talk about sort of ESG, sort of gone out of fashion a bit, but in terms of this kind of cleanup, the clean gypsum byproduct, I mean, does that help in terms of any pricing, and help in terms of grants? Does it offer any competitive edge for you?
Well, in terms of permitting, which people always ask about rare earth projects, first of all, for some reason, luckily for Rainbow, both Ilbaraba and in South Africa, phosphogypsum sources of rare earths are very low in radionuclides and other uranium and thorium, so we've just got what's known as background levels in gypsum, so that's not an issue for us, and that means we can export our product very comfortably. We don't have to worry about uranium and thorium, as I mentioned. But more importantly, the phosphogypsum stacks in South Africa are unlined, so we're going to be redepositing the gypsum onto a lined stack site, which will be protecting the groundwater in the area, which is near the Kruger National Park. So this is a very big environmental cleanup, and we're going to be selling the phosphogypsum into the South African gypsum market. So eventually, over time, even after we've stopped processing the gypsum stacks and they're all sitting back on line stack sites, we're selling this phosphogypsum at a rate of about 400,000 tonnes per annum into the South African gypsum market. And eventually, over a period of 40 odd years, those stacks will be completely level. So it's 100% rehabilitation of that site in South Africa. And as I said, that makes this project from a permitting point of view very important. And it's already a brownfield site, so it's not a greenfield site, which is always much more difficult. And now permitting is well underway. So there are no problems foreseen in South Africa. And in Brazil, we are on a brownfield site as well. It's already permitted. They've got 4 operating acid plants on that site already. We'll be the 5th plant operating within their plant perimeter. But importantly, in Brazil, they sell phosphogypsum into the agri industry in Brazil, and the gypsum we process, which will be slightly cleaner than the current gypsum they sell, will also be sold into the agri industry in Brazil. So on both counts, it's good for the environment and what we do.
Okay, interesting. And just before I kind of leave the conversation, I'd like to sort of understand sort of where you're at. So technically, what the challenges are. So you kind of move through to the FID. You're achieving some great purity rates, which is obviously the name of the game here. What are the kind of remaining sort of technical risks in terms of that kind of scaling to commercial separation?
So as I said, our front end process flow sheet is 100% using stock standard equipment in the industry, and obviously very scalable. We run now in large scale piloting. That's 90% of our capex and opex. That is moving very strongly in terms of our DFS. And our final step, which is the final stage, we're busy costing and designing that. And that final step will be, which will de-risk Rambo 100%, will be announced within the next, I would say the next 8 weeks. We'll announce that. And that's the final step. But I must add that we've been very successful in reducing our volumetric flow of pregnant leach solution. So with our gypsum, you use sulfuric acid to leach the ureas out into what in the industry is known as a pregnant leach solution, which speaks for itself. So all your ureas sit in the solution. We then feed it through what's known as a continuous ion exchange system, which we've designed and built many times as a team at Rainbow in the uranium plant. So a lot of the guys who worked for me at MDM Engineering, the company I sold to Amic Foster Wheeler, now work for me at Rainbow. So we've got a very strong team. We've worked together for a long time. And so that experience sits within Rainbow. And as I said, we're using continuous ion exchange. And that reduces your volumetric flow from 340 cubes an hour feeding that circuit to, by the time we've removed all the impurities, we're sitting at circa, and it's also rejecting cerium, we're sitting at circa 4 to 5 cubes an hour. So that volumetric decrease, which is 300 odd times, and we decrease the volumetric flow, means that our final separation circuit is very small in both capital and OPEX, and those final numbers will announce within the next 8 weeks. So as I said, we are 100% confident in Rainbow. It's the team is very experienced across all aspects of mineral processing, and the team between them have done 3 bankable feasibility studies in the rare space. Rainbows will be the fourth bankable that we're busy with.
Okay, so I guess that's that understanding of that kind of continuous operation versus pilot lock testing, pilot lock cycle testing. You think that variability won't. You understand the variability.
We understand the variability. And we run continuous ion exchange 24/7 in our earlier pilot plants. So we understand that part of the process, and we know it's dearest. And as I said, in terms of sizing of the CIX column, we've already sized that for the DFS, and it's a size similar to what we've built before in our uranium experience.
And what does that kind of cerium depletion step do in terms of how it impacts the kind of final plant design? What does it do in terms of the capex and opex trade-off conversations?
As I said, by successfully reducing the cerium out of our feed, means we have to treat about 26% less metal in the final circuit. So as I said, that bodes very well. I mean, we know the answer, but it's not public yet. But as I said, it bodes very well for, in terms of capex and opex, for the final separation circuit, because it's very small, because we've got such small volume that we have to treat. That's the significant cost saving in both your capital and your opex.
Right, and in terms of those kind of, I guess what you're trying to remove are these kind of bottlenecks between the hydraulic reclamation and the pre-leach handling of the gypsum. Is that right? I mean, and tell me about that, because I'm kind of fascinated.
Yeah, so we've also piloted hydraulic reclamation, which is basically using high pressure hoses to wash the gypsum, which we'll be doing that over a screen to just screen out any sort of over what they call oversized material, which it's a very fine material in the first place, and then that goes into the big leach circuit that we have. And we announced a while ago that we're looking at optimizing our whole sort of front end circuit, and the results of that optimization we'll be announcing very soon. We expect those to be positive as well. And once again, we're just finalizing those numbers, and it all means that we are very confident that our capital is going to be well within the updated capital number that we announced in the market in December 24.
Right, and in terms of the kind of the flow sheet variance, between the different projects for Phalaborwa, Uberaba, and like even like Morocco, for instance, is it just tweaking, or are we talking about wholesale change?
But I suppose the main reason we were able to do a deal with Mosaic was because we brought the RP, and what we recognize is about 80-90% of our flow sheet developed at Phalaborwa is applicable to Uberaba. That's why we've been able to go very quickly into some economic assessment on the Uberaba project, which is ongoing at the moment. So we're running 2 studies in parallel at the moment, and Rainbow, our bankable feasibility study, is well advanced for Phalaborwa, and we started the initial feasibility study on the Uberaba project. But because we had so much as applicable, we could go into the Uberaba project very, very quickly, and we'll be announcing the results of that feasibility study within the next 2 months as well. Okay,
and so what are the things that the difference? You talk about 80-90% applicable. The stuff that's not, what are we talking about, like reagent optimization, or is this kind of?
Yeah, it's just that each ore body is different in the world. Even when you're designing a gold process plant, so we've designed many as a team. Each plant is, you're all slightly different. There's slightly different sort of characteristics or hardness of the rock. You might have, the gold locked up slightly more in one gold ore than another ore. So even though you're doing a CIL circuit for gold plant, that CIL circuit is slightly different per mine. And the same as with us at Uberaba. About 90% of our flow sheet is the same, but we're tweaking it for, as you say, different strengths of acid, slightly different sort of filtration rates of the phosphogypsum. So you might have more filters or less filters. So those are the tweaks I'm talking about. The process is well understood. It's just tweaking the final configuration of the equipment and so forth.
Okay. And in terms of, I guess, again, come back to this kind of continuity thing, in terms of the things like, I guess, impurity build up in the kind of closed loop water or chemical circuits over time, is there much downtime required to kind of clean things out?
No, you always have a waste stream in all process plants. In South Africa, and same as in Brazil, you've already got a massive gypsum stack. So in both cases, so whatever so-called waste you've created is actually the waste that was there originally, and we're just going to redeposit it back on the stack. So we're not adding waste. We're not creating new waste. The acid is regenerated, and we're using the waters and what's known as a closed circuit. So there will be small waste streams, and these waste streams will go back onto the stacks from where they originally came from.
Right. Okay. Interesting. I guess just to kind of wrap things up a bit, can you just maybe remind us again, in terms of the next sort of 12, 18 months, in terms of deliverables, these kind of inflection points where you're kind of moving through to production, what are they?
Yeah, so within the next 12 months, as I said, we'll be completing the initial study on Uberaba. We'll be completing the definitive feasibility study on Rainbow, or the bankable, if you want to call it that. will also be closing out our project financing, and that will then lead us to FID on Phalaborwa. We anticipate production in 2027 starting, and Phalaborwa to be in production in 28.
There we go. Timing, it's everything.
Which is very quick for these types of projects, I might add. But it's quicker for the obvious reasons. We don't have all the pre-cost of having to mine all this material. It all sits above the ground. It's a resource, no mining risk, no geological risk.
George, appreciate your time today. Nice to have an introduction to your story. Stay in touch. We'll see you soon.
Thank you for taking the time.